eDreams ODIGEO is the world's leading travel subscription platform, reshaping the online travel market through its Prime model. In this deep dive, David Elizaga, CFO of eDreams ODIGEO, explains the company's new strategy and updated guidance, covering the shift to a monthly Prime model, the short-term cash unwind, and why management views this as a high-conviction move to unlock significant long-term growth and value creation. David, the stage is yours.
Today, we're here to discuss a pivotal moment in our company's history. Why now is the strategic time to invest in the world's leading travel subscription platform as we transition into our next phase of very strong growth. I would like to start by saying that we recognize the share price has faced a 60% correction. This was driven by the announcement of our new strategic plan in November 2025. We have chosen to add a monthly payment model for Prime on top of the existing annual model payment for Prime. This move causes a one-time unwind of cash in the short term, leading to lower cash EBITDA and free cash flow in fiscal year 26 and fiscal year 27. It is important to note that we still are guaranteed to get the cash, but over 12 months instead of upfront in one time. In essence, we are trading short-term cash upfront for a dramatically larger market share, aiming for over 13 million members and 270 million euros in cash EBITDA by fiscal year 2030. In addition, we will have a dramatically more diversified business that is faster growing with more subscribers. And despite the one-time unwind of cash, we still are guaranteed to get it with the move to monthly, which the market is not considering currently. Also, I think everyone should know that this is not the first time we have announced a long-term plan. Since I have been CFO, this is our third one. And each time we have met our 3-year guidance. In fact, this is no different from the one we announced back in November 2021, and we met our targets in March 2025, and we strongly believe the share price correction is unjustified, and therefore a good time to invest given we are very undervalued. In terms of valuation, let's tackle that first. Sell-side analysts are not pricing at all the upside of our new strategy. In fact, the valuations are being weighed down by, first, conservative assumptions. The most critical ones for us are Prime members and cash EBITDA in fiscal year 30, both of which are higher than what the analysts have previously modeled for fiscal year 30. And in fact, we grow by 30% more members than analyst consensus. Secondly, analysts are using significantly lower multiples of valuation. The consensus is a 6.5 times multiple versus the 10 times that the consensus was applying pre-strategy update. And the OTA sector, as a comparison, has a multiple of 13 times. And the B2C subscription companies, the consensus has a multiple of 16 times. So that is a very, very high discount. And they're also applying, when they do a DCF valuation, higher discount rates, with some analysts using a WACC of 15%, which is very unrealistic, given that the coupon of our bond, i.e. the cost of our debt, is 4.875%, so less than 5%. We are building a business that has a greater addressable market, that is more diversified by product and geography, and importantly, one that is de-risked from Ryanair content. As we hit our milestones, we expect these valuation gaps to close. If you do a sensitivity analysis, the upside is substantial, even using conservative multiples. That's why we believe that we are massively underpriced. At our current share price, implicitly, we're valued at only 5 times to 6.8 times EV to cash EBITDA multiple. Compare that to the 13 times average for OTAs or the 15.7 times for B2C subscription businesses. Even returning to our pre-strategic update multiple of 10 times and applying it to our investment years 26 and 27 would see our valuation and share price more than double. We believe the market is significantly discounting our future cash generation potential. So why invest now? Because we're doing this from a position of strength, and it is a high conviction move based on solid data from extensive tests, and it's not a defensive move. First, our model is de-risked. By fiscal year 30, we will be over 2/3 of our business being either non-European or non-flights. The second reason is that this is a team that delivers. We have already scaled Prime from 2 million members to 7.7 million members. Thirdly, we are accelerating the growth and the profile of the business. We expect record net adds of members of anywhere from 1.5 million to 2 million members per year between fiscal 28 and fiscal 30. Those are growth rates of 15 to 20% in the base. And finally, we remain committed to shareholders with 100 million euros share buyback planned over the next 2 years, even during this investment phase. All in all, while the company faces a temporary one-time unwind in the cash metrics, albeit the company is still guaranteed to get the cash over 12 months, it is doing so to capture a significantly larger market share, exceeding 13 million members, and a higher quality, diversified revenue stream. We have clearly demonstrated our ability to deliver on everything we announced in the past, being no exception the very aggressive targets we put at the Capital Markets Day in 2021. That strategic shift involves significantly more risk than the latest one that we are initiating. And yet we still delivered despite headwinds like the last waves of COVID, like Omicron, 2 wars in Ukraine and the Middle East, double-digit inflation for 2 years, and consumer confidence being below pre-pandemic levels. So the market should have no doubt that we will be capable again. Furthermore, the current strategy is more conservative and designed to ensure future growth, building upon the existing solid foundation. Our targets are clear: more than 30 million members and 270 million euros in cash EBITDA by fiscal year 30. After the planned dip in fiscal year 27, as we transition to the monthly model, we expect a massive 33% CAGR in cash EBITDA from fiscal year 27 to fiscal year 30. As these new members mature, we expect cash EBITDA margins to come back from 15% to 23%. And to be very clear, the anticipated decline in EBITDA margin over the next 2 years is solely due to expansion into new products and geographies as a result of the initial investment necessary to support the company's future growth. We are building a high margin, predictable subscription powerhouse. In summary, we are delivering a much better business. We are achieving high growth with a 15 to 20% Prime member CAGR from fiscal 27 to fiscal 30. We are seeing higher customer lifetime value and stronger loyalty with a 10% increase in Net Promoter Score. By fiscal year 30, 2/3 of our volume will be diversified away from the core European flight market. We are inviting you to join us as we believe the market has overreacted as we execute this final stage of becoming the world's preeminent travel subscription platform. The market is currently using conservative assumptions and high discount rates, valuing us at an implied 6.5 times cash EBITDA multiple of fiscal 26, well below our historical 10 times multiple and the 15.7 times average for B2C subscription businesses. We are currently in a transition window. The one-time cash unwind is planned, but we're still guaranteed to get the cash. The growth in the plan is accelerating, and the valuation gap represents a massive upside for investors who recognize the strength of the world's leading travel subscription platform. And I will conclude by saying this is a high conviction move based on solid data from extensive tests and not a defensive move. It was a change in the strategy from a position of strength. Thank you for your attention.
Thank you, David, for the clear and candid insights into eDreams ODIGEO's new strategy and long-term ambition. This deep dive highlighted why management sees the current transition as a high-conviction move and a compelling opportunity for investors. For more in-depth video presentations and strategic insights from listed companies, visit Seat 11A and stay tuned for further updates.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.